Hey guys, it's Peter Cunha, your New Jersey real estate giant, with my buddy David Baum. How are you,
What's
bud?
up, everybody? What's up, Pete? Thanks for having me.
Hey, this is our weekly call. Dave and I were just kind of talking about what are some hot button topics that people are talking about right now, and we both agreed that the 2-1 buy down or some sort of buy down to pay down, I guess, interest rates in the early years of your mortgage, typically your first year and your second year. I was not aware of this, but it can't be paid by the actual buyer. Yeah.
So basically what we're seeing is most of the time, if people are looking to do with where these interest rates are right now, people are trying to figure out any which way to maybe get some relief, right? You can pay discount points to maybe lower a rate. You can look at a buy down, right? And a buy down are good. Typically people look at what's called like a 2-1 buy down. There's a 3-2-1 buy down, or there's like a 1 buy down. So usually it's either like 1 year, 2 year, 3 year period, right? So a 2-1 buy down would mean that, say you have an interest rate, and let's just use an example, right? Round numbers, not saying this is where rates are or whatever, but if an interest rate is 7%, right? A 2-1 buy down means that for the first year, your rate could be 5%, okay? Year 2, your rate would be 6%. Year 3 through 30 would be at 7%, and hopefully you'll be able to refinance before that even gets back to that point. But basically, that buy down, it will absolutely help a borrower lower their mortgage payment. It is not going to help them with qualifying for more money, because the underwriter is qualifying that borrower on the full rate, not the discounted rate. Okay. I just had a realtor ask me the other day, can the borrower qualify for more for this? Unfortunately not, because the underwriter is going to qualify at the note rate. Now, what does this mean, right? So if you're doing a 5% for 1 year, 6% for year 2, and 7 in year 3, right? So what's the cost for this? So the cost is basically how much they're going to save in year 1 and year 2, and it's going to total up to a number. So if the cost of how much they may save with this buy down is $10,000 over the first 2 years, or $12,000, that's the cost of the actual buy down. Now, the unique thing is that a buyer cannot pay for this. It's either seller paid, it is builder paid, it is lender paid, right? So there's a combination of the three, but unfortunately the buyer himself or herself are not able to physically prepay that.
So can I ask you one quick question? Because I've
Yeah.
seen a lot of buyers, especially from up north, specifically New York, Brooklyn kind of area, where they're asking for the realtor to kind of step in and put down some of the commission towards some of this buy down or pay down, or um, is that kind of, I've never personally done that. Are you kind of familiar with that? I know that you deal with
Yeah,
Middlesex.
so it's more like an ITP, an interested third party, in essence, right, of the transaction. Typically, it's just it can't be the buyer themselves, right? So whether it's in the form of a concession, if any seller or any realtor credit is, you're not going to get a maxed out seller concession and a credit from a realtor, right? The most you can have from an interested third party, is going to depend on the rate. I'm sorry, the type of loan. So if it's a conventional loan and you're putting down, less than 10%, your seller concession is 3%. If you're putting 10% or more, you can get a 6% seller concession, or a interested third party concession, basically, right? Whether it's a combination of anything. If you're doing FHA, you can get a max 6% seller concession. If you're doing VA, max is 4% for a concession, right? If you're doing an investment property, it's typically max of 2% of a concession. So all of that matters, right? And it's just kind of getting creative with the offers. I know that, in North Jersey, this realtor was asking me all this stuff. They're still super competitive and tons of extra offers. I mean, some of our houses, the same thing in our area too, but not every house out there is, still in like the battle it was 6, 9 months ago, but the good houses priced right, yeah, there's still going to be a lot of action. So it's just really trying to get some creativeness, but it could absolutely help a borrower out, save a lot of money, kind of prepare, for the future. And then in turn, there are some positive signs out there that, heading into next year, they're saying, next summer could be a really good summer to buy. There are talks, and there's no guarantees, obviously, because we had a lot of forecasts that were way off for this year, right? On where rates were going to be the end of this year. But we are starting to see some positive news out there that, as rates are still kind of skyrocketing, and there's like that stagnant, purpose of like, when you got a roller coaster, right? And roller coaster goes up, as the front's coming down, the back's still going up, right? And then I think, so basically heading into December and January, as we're kind of cruising through this inflation into the recession market, and kind of that once the full roller coaster gets past the upswing and down, there is some positive signs out there that rates could be back into the low mid fives by second, third, fourth quarter next year. So these buy downs can certainly help these people in the first year. They may be refinancing in year two, or three for that matter.
Right. And that's kind of like, somebody put me on the spot last week, and they said, what do you think of the market? I said, this is a great time to buy. And they thought I was kidding, tongue in cheek. And I said, listen, you got a great opportunity here. Inventory is certainly going up. I know that there's places around the country that are hurting right now, like San Jose, Boise, Idaho, or it's like, I get that. Somebody showed me a TikTok video, and I go, I don't even, like, I couldn't point out San Jose. I could guess where it is in California. I'd be at a loss. It's like, pull the trigger, because I have no idea where Boise, Idaho is, right? Like, on a map. I really don't.
I definitely, I think I could figure that one out. San Ho, maybe not, but kind of in that, probably
Yeah,
south of San Fran area, if I had to guess.
yeah, but like Boise, Idaho, I'm like, all right, like, number one, like, I'm just trying to stay on top of my market. Like,
Yeah.
I appreciate everybody reading these headlines to me, and I'm like,
Yeah.
we're at a break even point. We're definitely, we talked about it last week, an inflection point where, showings are down, I guess, 12 to 15%. I think that we showed a chart where inventory is up 25%, but houses are selling. I did an open house, 2 hours, I had 30 showings. I couldn't get people in and out. I mean, you're talking about big families coming through.
Sure.
It's like, because we priced it right. And I always love it. When there's 10 offers and some guy goes, do you think there's room? And I'm like, yeah, well, how much room are we talking about? It's like, $50,000 less. And I always tell people, I'm like, listen, you're probably not going to be the number one offer right now, probably not number two, but I'm seeing deals fall through. Even with my open house that had 30 showings, I had 2 deals fall through in less than a week. It had nothing to, we didn't even do the home inspection. It was like, literally, one buyer who's, that had the best offer, his job might be relocating him out of state, right? And he goes, I don't want to make this big commitment, but I love the house. Second buyer, just, he just got cold feet. And I'm like, all right, there's buyers out there. Like I said, 30 people came. I just got to find them houses.
Yeah, a lot of, I mean, we're definitely seeing some people that, whether they're second guessing themselves or not, but it's also too with, as these rates, are moving targets, right? And the people are, when they, usually when you're out of attorney review is when they lock in, right? And their loan officer should be, keeping them abreast of the situation and be like, hey, right now, and it's important for us, all our pre-approvals in the past few months, right, of just updating them, because where they were pre-approved back in April, May, June, July, they may be approved for less money right now because of rates rising, right? So all of that stuff matters. And then when the people are out there and they realize they just might have overpaid, 30, 40, 50,000 above a list price, and then see where rates are, and then like, whoa, I don't want that payment. And then you'll have the shock that way, and then they'll back out. I mean, it's a lot of people I talk to, a lot of realtors I talk to too, they're just, it's a little, it's a little funky right now because there's more fallout, than they've noticed in a long time right now.
That's
Yeah.
what I told everybody, it's like anybody that I was representing on the buy side, I go, listen, there might be an opportunity to get back in there. And, it's like literally that's all like, hey, listen, you're not the highest offer right now, but really good terms, you're willing to eat the first 5 or $10,000 of the home inspection. You're certainly qualified. Let's see how it goes. And I don't know, it's becoming really creative, and this is what I love about it because it reminds me of my Wall Street days, where you're just trying to package deals, that makes sense for everybody involved, right? It's even this buy down. We were talking about this before we actually started recording. It's you might save 8,000. So by you, I mean the buyer, right? And then that's year one, and then say year two, you save 3 to 4,000, which would be the buying down
Mhm.
1%. So how much is that really costing let's say the interested third party, the ITP, right? The
Yeah.
seller, the
Right.
lender,
So let's just take an example on a $500,000 house,
right?
right? If it's a $500,000 house, right? Well, if you could save, $12,000 or 11,000 over the first 2 years by that buy down, well, that's what the cost of the buy down actually is. So the question is, that's almost 2% or a little over 2%. I think they said the average of a buy down, when you average like the cost, because all price points are different, right? A smaller loan, you're not going to save as much money, right? So I think they said it's about like 2.4, 2.5% the actual cost of a buy down, points,
Right.
which is a part, if you can get a seller concession for 2, 3%, that should cover the buy down. Or if it's a combination of something, that should cover most. But the problem is the buyer cannot pay. The buyer cannot pay discount points to then get a lender credit, because really they're paying for it. That's not the way it is, right? The only
What
way, lender credits are available, unfortunately, is typically when they take a higher rate to then get a credit. So,
right. Okay.
there's different, you know, you're trying to get the lowest rate and the actual benefit of a buy down, to really, really take advantage, obviously, of something like that. Can be done, but not in all instances do people have an opportunity for a concession. Some sellers they don't want it.
Right. And that's the whole thing. I think that just people talk, you mentioned it. A lot of realtors just, oh, like two, one, buy downs, right? What's the other one? It's cash for keys programs, right?
Right.
And it's
Yeah,
like,
we have that, but
yeah, but you and I, like, again, is it the best option? Yeah, there's certain people that are good, candidates for that, but if we could avoid that for whatever reason, that's great too, because I think that there's better financial vehicles for them in the long run. And
yeah,
it's
there's a cost to doing that, even if you literally just for a pre-approval, it's a pretty much a point to go through that program. And then even if you don't close with it, it's like,
right,
it's not for everyone. It may be a benefit for somebody. But typically the buy downs are great. I mean, paying discount points right now, obviously they're tax deductible deductions of interest, as long as mortgage interest is less than a certain amount. Obviously speak to your CPA on that. Usually I think it's 750,000 of mortgage interest you're able to deduct up to. But talk to your CPA. Obviously we're not, condoning tax, advice. However, discount points, people are paying points right now. There's not really a no point mortgage out there right now, unless it's just a higher rate. Unfortunately, that's kind of, industry standard right now, as we're all going through, this influx of inflation, and hopefully the tail end of it, the inflation period into the recession, but we're not quite over the hump just yet. Hopefully mid-November readings come out and things may start to look better heading into the first quarter of next year. But right now, we're still dealing with a very volatile market.
Yeah, and it's funny that you mentioned that. I love that roller coaster analogy because, we're kind of, I think I guess we've been kind of desensitized to inflation numbers in the eights. Now we're going to a year over year cycle where if it says that they're up 2% next month, that's still really bad
Yep.
because you're comparing it to a +8 the year before. Not that I'm an economist in any way. Do I want to be one on TV? No, but it's just something to keep an eye out for. In another mastermind group, we're like, what are the top three topics that anybody ever talks about? It's like inflation, interest rates, and the election. And then number four is the geopolitical, Ukraine,
Yeah.
Russia, China, et cetera. But it's interesting to see like how these factors will have an impact, and you know, uh, I guess this was the last round before the November 8th election cycle. So,
Yep.
um,
Yeah, so the October readings will come out in November. And then I think ultimately, they already are talking of another 3/4 point hike in November and maybe a 50 basis point hike in December. So when they've been hiking, 100 basis points, 75 basis points, 100 basis points, or more, like
right,
at least that part is starting to come down. There are talk right now in the Fed that there's people that are like, guys, we haven't really thought about the ramifications of hiking rates too quick too soon. We might want to rethink this and, put the brakes on a little bit. So there are some signs, like I keep saying, better days are ahead, right? You hear me? I keep saying that. Um, from what some people are, definitely forecasting out there, next, second, third quarter could be, we might be in a much better position than obviously where we've been the last few months.
yeah, and I agree with you on that, and I have no point to like really say that. I have nothing other than my gut, and I have a pretty big gut, right? And it's just like I saw Elon Musk saying, I guess, spring 2024, the recession could go out that far. And again, who knows what he's basing it on. All I know is that I'm seeing a lot of buyers that are out there. I'm even picking up new buyers that, it's weird because I remember when I got into the business 10 years ago, those guys that were what I considered my savvy investors haven't bought a house in 5 years.
Mm.
Then you pick up the next wave of savvy investors that, have bought houses for, the last 5 years. And then, it's like now I'm picking up a new crop because they're just like, as far as they're concerned, this is just normal, right? So, and where they come from too is, do they have construction crews and like what is their cost? That's a lot of things. Everybody's always talking about the top line. What about the bottom line? That's at the end of the day, that's the most important number. How you get there doesn't matter.
Sure. Yeah. I mean, yeah, if they can do work at cheaper than, obviously somebody else and versus someone having to pay someone else to do it and things of that nature, I mean, that's going to affect their bottom line for sure,
Right. So
but
yeah, but Dave, this has been really helpful. I know a lot of people, and I'm gonna tag this one as like buy down, pay, 2%, whatever, year one. But we're we're seeing a lot of creativity. And it's not that people aren't qualified. It's just, we're finding ways to get numbers to where they need to be. Even my buyer, he had gotten an accepted offer even though he backed out. And he was just so giddy because he was at 5.5%, but that was on a 20-year loan. Where I asked his friend who bought a house 2 years ago on a 15-year loan, and he was in the low twos,
yeah, low twos. Yep. I talked to someone yesterday. I refinanced at 2.25. And she was like, David, I really want to thank you. I'm like, I know, because you're never going to see that rate again, most likely, right? Unless there's a major problem in the, in the US
Right.
or the world globally. And also too, the rates that we were talking about with a client, she was like, God, she's like, I wouldn't know what to do if I had that rate. I'm like, well, your payment would be over $1,000 higher from, from the loan amount, the size that you have,
Right.
and obviously very grateful. But and someone else too, I closed in June. I was texting with back and forth with him yesterday. And he's like, you were right. He's like, because he was complaining at 5,625,
Right.
on something. And he's like, he's like, you were definitely right. I wish I bought 6 months earlier, but I'm glad I bought
At
6
5.
months earlier than where it is now, because that complaining in the, mid fives, his payment would be another, $400, $500, $600 more. So, it's just, we all got to get through this, at some point in time in the near future, hopefully next year, we'll start to see a dip, but it's still, we're not there yet. So we all just got to keep getting creative ways, getting people into houses, they're fall in love with the house. And once again, we can refinance at some point in time down the road.
Yeah, I'm gonna give a shout out to my boy Alex Maldini. He's one of my good friends. He's Brazilian, and he goes, Pete. He goes, when's the last time we've had a dip in the economy? He's like 14 years ago. He goes, this is good. He goes, whatever it is, a year, 2 years, 3 years, and then everything will be fine. It's like, I was like, you know what? That's a great optimistic way of looking at it. So everything's going to be just fine. We just got to navigate through the seas. A lot of good information here, Dave. I appreciate you as always, my friend. Let's see what the market brings, and I'll connect with you next week for this weekly video. And I just appreciate you being on top of these things, man. Thank you.
Sounds good. Have a great day, everybody.
How do people get in touch with you, Dave?
They can hit me up 732-853-4969, or hit me up with an email, david.baum@ccm.com.
Appreciate you, bud. And listen, feel free to get in touch with me as well. 917-690-5390. And don't forget to smash the subscribe button. I'll talk to you guys later.
All right. Peace out.